Hi everyone, I'm Elad, one of the founders and CEO of MarketAcross, one of the biggest and most prominent PR agencies in the space, been around since 2014. Also, one of the founders of Chainwire, which is the biggest press release distribution platform in crypto. And maybe we take a few minutes to introduce yourself and just tell a little bit about your background and what brings you here. You can start.
Hi everyone, Marien from MEV Capital. We are a DeFi asset management company. We manage about 2 billion USD across different strategies, and most of the strategies are on-chain. So here to talk about DeFi.
Hi everyone, I'm Luis Torras. I'm one of these bankers that from the other panel that they just mentioned that we are around. I'm a business sell-side equity analyst and also a wealth manager, about 2 billion of assets under management in multifamily office, and basically traditional finance still.
So I guess I'll join that, but I actually have two hats. So the boring banking hats, I guess, in this conference, where I represent 10 of the wealthiest families in Denmark. Within that context, we saw a few years ago that we wanted to have exposure to this blockchain universe. So we established our first product ever, because we are independent, so we don't like products. But we didn't know how to express that multi-family office boring way of getting exposure to a new technology. So we established a fund of fund internally. So we have two fund of funds, and that's my cool hat when it's facing backwards. We run a fund of fund business on the side, and maybe going into venture as well. So we have exposure to some of the panelists beforehand, Animoca Brands, Ledger, some of the larger players within the space as well.
Thank you for that. I'll start with the first question. We're talking about institutional adoption, and we can actually see it. Like if you walk around this conference, you see more people suit and tie, less degens, and like the usual crypto nonsense and meme coins, and it's becoming very like the big boys are coming in. And what do you think are the biggest drivers, like micro environment in 2026? Like we've seen the plays from the US, like the Genius Act, or things that are kind of solidifying or creating frameworks for institutional asset managers to feel more confident in deploying capital. What do you think are the main drivers around that to see more institutional capital flowing into the markets?
Yes. First of all, the Genius Act changed a lot of things, and the on-chain is DeFi is very limited, but stablecoin on-chain. So for now, it's mostly dominated by US, and as soon as we will have more liquidity through new stablecoin issuer, so we have seen new stablecoin issuer. Now we have also in France, you have Société Générale, who has started DeFi 2 months ago. At MEV Capital, we are the exclusive partner. It's still small, only 100 millions. So nothing to compare with giant like Circle and Tether. And mostly we talk with many banks, many issuers. They have stablecoins, but they don't want still to use into DeFi. And they say, okay, we have stablecoins, but it's not transferable. So to grow DeFi, we need more liquidity and also more what we name asset management on-chain solution. It's what we do at MEV Capital.
I think if I have to underline some elements, I would say that first of all is the track record, especially on Bitcoin. I think that it begins to keep an eye on institutional investor. I mean, there's some things that still, in my opinion, does not fit the traditional finance mindset, because to me it's a problem of mindset rather to talk about metrics or to talk about volatilities and things like that. That's, to me, is point number one. And point number two, and probably third, is the regulation part and that we have now a push on the US administration that is quite conjunctural, but I would underline also as well the macro environment. I mean, we've been through a period of very volatile, monetary policy, with changes not only with the monetary regime, but on the rules that apply the Fed to manage money. And I think any investor that traditionally, family office that need to protect capital, they begin to see how the fixed income is not an option. We've seen now how the gold has become a crowded trade. I just want to mention that, I mean, anyone was invested in gold 12 months ago, only the central banks, and now it's beginning to being adopted by institutionally widely, I would say. So I think this for me are the two elements that begin to make this traction on the institutional segment for Bitcoin, and hopefully, probably also in the rest of crypto with time as well.
I think we tend to overcomplicate stuff in this industry. The institutions are here, and time is the only thing that's keeping them from coming into the space. We have regulation in Europe. We now have regulation in the US. So the institutions have no issue coming into the space. So time will get them all here, in my opinion.
You spoke a little bit about volatility, and that is something that usually scares institutional investors, right? So I'm in crypto since 2012. It used to be like Bitcoin could go down 70% that time, and that's what we would call a Tuesday, you know, like you see that it's stabilizing a little bit, and that even now you've seen like the flash crash that happened a week ago. You literally held altcoins dropping 80% and then bounce back. Bitcoin didn't take a big hit. And some would say that it's because the institutionals are in it, because of the ETFs, because of they don't have they have more of the diamond hands. What do you think, where do you think that smart money will keep flowing next? Would it be more focused on like early stage startups, investments, VCs? That was a big thing. Let's say it's usually a bigger thing when the markets are green. When the markets are falling, people are looking for less opportunities. Or will it be more of like hedge funds or buying liquid tokens? What do you think will be the next trend in that regard when institutionals are in?
I think we have to define what smart money is, because institutional money can also be dumb money. Pension funds will not be the first ones to adapt a strategy into that. They'll not be the first ones to buy the ETFs. They'll come in the second or third wave. So if smart money is not institutions or not pension funds, what is really smart money? I think smart money can be family offices, it can be ultra high net worth individuals, it can be wealth managers across the world that are truly independent and don't have a compliance department that they need to check XYZ before they can push a trade. And smart money are already chasing the volatility. They're already seeing the arbitrage opportunities within the space, and they're just looking for these mismatches in and around the space. What I'm curious about, if over 2026, I think crypto is becoming such a mature market that we can actually see other markets being as interesting for smart money as the crypto market. Some of the delta neutral strategies that I speak with on a regular basis within the crypto space, they haven't been able to give 30, 40, 50% returns this year. Why? It's because all the smart money is already in the space. They've been able to do 10, 15%, which is a lot for delta neutral strategies, but it's mimicking what they are able to do in other markets. So in my opinion, smart money is already here and have arbed out a lot of these inefficiencies that we see in the crypto space. And then we have a Black Friday like Friday. So that's why I'm probably completely wrong.
No, absolutely. I'm very agree with Adrian picture of what institutional money does. And I would just add one thing that related with what Elad underlined, which is very important, which is volatility, which is at the end of the day the 90% of the conversation, and the thing that you can address or you can have exposure to blockchain or what we call crypto in two ways, because there's like different type of assets. You can play the liquid Bitcoin asset play, in which you try to, is a trade that wants to be similar or better than gold. It's a protection of capital in the long term, at least in the concept. But at the same time, and paradoxically, you're having a lot of the volatility that you typically find in a tech small cap. And this is like a challenge that you need to deal. And the other side, and it's very interesting with Adrian, we talked it earlier, is this type of approach in which you try to approach Bitcoin and all this ecosystem as a VC segment, VC, I don't know how to say it, sub-asset, in which you emphasize that you are investing in tech, which is also, and with these VC vehicles, you try to modulate volatility and can be another, let's say, Trojan horse to enter in what today are traditional portfolios or non-smart money, to say it politely.
Yes, I will say that most smart money are looking for stablecoin strategy. They don't want to take risk in Bitcoin. When we talk about corporates, of course there is some famous name who invest in Bitcoin, but now most of the company just want to manage their treasury in euro, USD, and they are looking to compare with what they do with traditional finance. So now they know that they can have the native yield they have with like money market securities, like treasury bills. But in top of that, we can put in some money market like Morpho, and to have some additional yields. And for them, it's like interesting because they don't take any risk on the volatility of Bitcoin, Ethereum, or whatever assets. And the yield on stablecoins are the highest you can find in the universe of traditional finance and DeFi. It's about 15 to 20%.
So right now you see a lot of, so we know the MicroStrategy Michael Saylor model, right, where they keep buying Bitcoin as a treasury, and it started off as being just like a side thing, and today that's everything around strategy. Like there's no, it almost looks like there's nothing else there. Do you think that that trend is something that we're gonna see? Because you do hear about publicly traded firms quietly acquiring Bitcoin, and sometimes not quietly acquiring Bitcoin and then announcing it, and then it looks good on the stock because, you know, they follow the strategy model. Do you think that's a valuable trend, like something that we're gonna see more and more and more, like more publicly traded companies put Bitcoin on their balance sheets? I mean, we've seen it with Tesla before. We see it with the US government. We see it with, you know, publicly traded stocks now. But is it a trend, or do you think this is the beginning of connecting Wall Street to Bitcoin in the sense of like the treasury model?
Yeah, I think it's a question of $10 trillion because if we know the answer, we will know that the Bitcoin will go to 2 million price. We have seen Luxembourg government is the first of European states buying some Bitcoin from the government, not treasury, but the government like foundation. So the speculation of Bitcoiners is like Bitcoin will be the main assets and to preserve value beyond the inflation. So if we are confident on this way, we can think that more and more corporate will buy Bitcoin, and because now the only obstacles was regulation and also the fear of investors. So now we can see that everyone can accept that we allocate like 5-10% to Bitcoins. It's not look at crazy as before.
It's a good question. I would say that here again, I see like two paths. Because on the one hand, if I try to imagine that I'm the CFO of a public listed company here in Spain, and I mean, if you read the textbook, what you need to do with your treasuries is to keep them safe. I mean, first of all, you need to do there's a game changer for your shareholders. There's a change in the governance on that treasuries. Second of all, it can be a good long-term decision, but if you are not, if it is only for treasury management of this company, it's going to add volatility to the balance sheet. So it's a game changer with your shareholders. If the other path is that part of your business model is going to be to buy, acquire, optimize this process of acquisition and maximize the Bitcoin per share, which is, I think, is another business model. I think in this trend, to me, is clearly that has momentum right now. Has its difficulties to invest. I don't know if we can talk it in another question. But yeah, I think it's interesting. And the first one, I think, may be, how to say it, more slow down. I don't know, companies here in Spain that has a lot of cash, Inditex, for instance, well-known fashion brand. I do not foresee in the coming months or years that part of this cash that they have, they transform it in treasury, because it would imply a change in what you own as a shareholder. So I think that to be a main obstacle for this mass adoption of corporations so far.
I actually hate it, but I tend to agree with you, Luis, but for a slightly different reason. So what is the treasury function of any company? It is to keep the business afloat. And we have to remember that we are speaking about businesses. And they have their daily operations. And how do they fund their daily operations? Right now it's through euros in Europe or US dollars in the US. So they are not going to buy a treasury thing, a Bitcoin, if the prices for the vendors are denominated in US dollars, because it adds too much risk to the balance sheet, in my opinion. So what needs to change is that the way we interact, our barter system or our shopping system in the world needs to be denominated in some form of cryptocurrency in order for everyone to adopt a Bitcoin on their treasury. So as long as we still finalize or settle payments in dollars, I don't think we'll see a large inflow of companies around the world that are super well capitalized, adding the risk of volatility to the balance sheets. It's a completely different thing, in my opinion.
So that leads me to the next question. We look at Bitcoin as a volatile asset, but you can't even compare it to like all the altcoins, right? So now we're actually seeing a trend of a few things. One, foundations of different altcoins that decide to actually open or publicly list these altcoins in the form of, so I don't know if you've seen the Trump media announcement with crypto.com. So Trump Media is a publicly traded company. Now they acquired a lot of CRO tokens. And then, of course, there's a utility. They're going to use CRO in Truth Social, which is a Trump Media-owned product. So now they have a treasury for CRO. It's not even Bitcoin. Is CRO good or bad? I don't know. Is it volatile? 100%. And a lot more volatile than Bitcoin. So now that's one thing. You have like foundations that are doing it. And then you're also seeing DATs, like decentralized asset treasuries, that say, yeah, we hold Bitcoin, but that's only 50% of what we hold. We're also holding 10% of BNB and 10% of Solana and then 10% of Avalanche and whatnot. What do you think about that? Like, where is that going? Because that could be the best thing that happened to the crypto industry, or the worst thing that happened to the crypto industry, because a lot of people that are not really exposed to people, don't know how to even open a wallet, can now be exposed to what you call shitcoins. So when that drops, what would be the effect on the market? So just to play off what you said about volatility, I think that's a lot more volatile. Is that and it is a trend. So where do you think that is going, and what would you think? How would you think that would evolve?
I think these new DATs are just another way of getting exposure to some underlying stuff. To me, these are masked hedge funds. It's a way for either bad actors or good actors with a good idea to do a levered play on an existing thing, which is, to me, just another way of saying you're adding a little bit of leverage, or you're adding a strategy in and around something to be, making it more valuable. So to me, I think this is a little bit of overhyped. I don't think that's just the new big shiny thing within this industry. Yes, Michael Saylor has done a tremendous job of being a proponent of doing these strategies, but I just don't see them competing in any way with the flows that we've seen from the ETFs. The ETFs are by far outcompeting these stats with flow. So to me, it's an insignificant market risk to the space as of now.
Yeah, I would add to what Adrian said that let's take a strategy to me which is easier to understand, and the example that you give us, I think it goes beyond that. But basically, when you add the treasury company, what you are adding is layers of complexity to the underlying asset, and the overall thesis becomes much more complex. In the case of a strategy, now you need to have the high conviction of the asset underlying the security, which is the Bitcoin, of course, but then you need to validate the management team, again, the governance, which is very delicate issue that can add a lot of volatility because links directly, it's very sensitive with the trust that you can build with your shareholders. You need to validate the capital allocation model. You talk about different tokens, so it's very difficult. You are not buying the token. You basically are buying the trust in the management team of the company and how they are going to perform and use these sources, and they are going to invest properly. So at the end of the day, you are playing another game. To me, it's interesting strategy. For some of my clients, it's a way to gain exposure to Bitcoin. It's not the best way. For some clients, because of compliance, legal, and many stuff, is the proper way to do it because you have proper custody. It's easy if you just open or operate with public equities, but you need to understand that you are going to have much more volatility than the underlying asset for the reasons that I mentioned, that you need to validate there are some other complexities that, I mean, it can go very well when the cycle reverses, but you need to understand that there are more sources of uncertainty and potential risks.
Yes, if you look for the 3 years volatility of Bitcoin, it's not so much higher than stock markets. The risk is in the last few years, except if you isolate some few events, it's almost very similar. And there is a high correlation with S&P 500. And for the Bitcoin treasury, and it can be also the Ethereum treasury of BNB treasury, now all these companies want to find solution to offer yield, because it's beautiful to have assets in the company, but if you have assets like Euro, USD, you can invest in traditional vehicles like T-bills to generate returns. But for Bitcoin on Ether, it's more difficult to do. So now the next big meta will be to how to generate yield on how to grow the company assets.
So in the last cycle, or actually in every cycle in crypto, you always have the trends, right? So it used like in the current cycle it's RWA, it was, or it still is, and deepin, and then the building on Bitcoin was really, really hot like a year ago. Everyone was suddenly building on Bitcoin and talking about ordinals and all kinds of stuff like that. And then if you look even like before that, there was DeFi Summer, that was like insanely well for DeFi protocols. And then you have NFTs and meme coins and, you know, stuff that hold no value. Do you think, like, from that perspective, how do you see asset allocators, institutionals, VCs, or what we call smart money? How to navigate that landscape, chasing the trends, ignoring the trends, trying to get in on the trends? What kind of risk assessments or what are your 2 cents on being or being against those trends?
I mean, everyone can create its own strategy and try to follow the next narrative and jump to one protocol to another, to one chain to another. And but the time to do the due diligence, to talk to the team, to evaluate all the risk, it takes a lot of time. And there is no one company, even the biggest one, who have a dedicated department to do that. So they have to delegate this power to some asset manager, and but they want to have a control on the policy, what will happen with the assets, what the manager can do with the assets, because in DeFi there is so many opportunities, and so they want to navigate into these fields, but they have to delegate the framework on what they can tolerate in terms of risk. And the principal use case is basic one of lending and borrowing. Institutional will not come to do some basis trading of some tokens because the size is too small. If you want to allocate 50 millions of euros into a strategy, you can do that. It's like too much. There's not enough market liquidity. So the main strategy always seems the same. It's always to put, for example, Bitcoin or Ethereum, what you have as collateral, as supply, and you borrow stable coins, and your goal as asset manager is to generate more returns than the borrowing side, and it's like this you generate yield.
Well, to me, I don't have a specific view on the strategies that we can foresee in the coming months and years, but what I can tell as a overall insight of what I'm feeling or perception of talking with clients and people that are investing in the ecosystem, what I see is that people is beginning to focus more not only in the narrative. You mentioned the meme coins and all these kind of things. I think these are like in a video game. There are phases that we are passed through that, and we are in another stage right now. I think that actually that we've been talking about institution all this afternoon. I think they can enhance how the overall ecosystems manage risk. And I think, and I foresee that we are going to see how risk is going to be much more better managed overall in the coming cycle. Probably, just Marien just mentioned, important to recognize that it doesn't mean if a token or any investment has a public quote, does not mean that has the proper depth and liquidity to take it out. That's very important. Any project that has subsidies and helps and all, this is not income. So I'm perceiving that some practices that are very deep rooted in the traditional finance are moving to the crypto space. That's on the one side, and on the other side, and because of it's inevitable that if we are beginning to a more, let's say, easy money cycle again, history tells you that I mean, when the money is easy to and the liquidity pours, the risk management tends to be a little bit lower. So we probably will see a little bit of these two in the coming year.
I don't have an opinion on the hype cycle in digital assets, so please.
How do you, so you mentioned like risk and liquidity, right? That these are two things that are kind of, like you're in crypto, it's by definition like a risk-taking position, right? But then institutionals are not very fond of taking tremendous risks. What do you think are like, how do you balance that? Like getting on the VC route with like private rounds and then buying tokens before they launch, and or buying like top, like very small market cap tokens that, you know, you can 1000x or have this dream, or more of like a stable type of conservative buying only very liquid tokens in the open market? How do you balance between the two? Because crypto is about that, but now it seems like it's changing a little bit.
Crypto is a risk asset, and I think it's completely false that institutions are not willing to take risk. Every single institution in this world is, within the finance industry, is there to take risk. But it's a balancing act. It's not about if you want to take 100% risk or not. It's about balancing that risk to your mandate. And the last 5-10 years, crypto has been in a way to express the higher end of that risk spectrum. Someone from Bitwise told me this morning that their target for Bitcoin is $1.3 million or something like that. That's a tremendous, tremendous number. But it's 10 years from now. That's a CAGR. This is their numbers, don't hang me up on it. It's a CAGR of 28%. I bet you within the normal finance world or within the normal VC world, some other players within other industries are going to make 28% CAGR as well. So we've come to this inflection point where you can certainly use crypto as a risk asset, but you just have to balance it out with something else in your portfolio. And I think that's why a lot of asset managers are looking toward adding Bitcoin to their balance sheets, is because it's a high beta product compared to a NASDAQ, for example. And then our question within this industry, if we just focus on the digital asset, is can we beat this benchmark of 28% CAGR? Maybe yes, maybe not, but you have to think about the added risk that you're also taking to going into token launches, or you're going to add by adding exposure to DATs. And I think we're in a weird dynamic in this market cycle where Bitcoin might be the best risk-adjusted place to be for the next 10 years, or we see market participants actually adopt some of these new DeFi things that are coming out. And if that's the case, that the total globe actually adopt blockchain rails, then we'll see a lot of returns in the VC market on a risk-adjusted basis. But we just have to remember that these big institutions, they're balancing risk. So whenever they want to be risk on, they go further down the risk curve. And right now, everyone and their mom are exposed long to risk because of this debasement narrative that's going around the finance industry. So everyone are long risk. No one is short risk at this moment, and we just have to be aware of that. And that can continue for 5-10 years. I'm not saying it will stop. We just have to be this balancing act, these weights on each side of the coin. We just have to be sure where we are in the cycle of risk taking. Sorry, that's a long ramble, but.
Yes. The reality when you talk to some corporate and CFO, the difficulty is to teach, because they never heard about some protocols, how it works oracles, how it works liquidation, how it works liquidity pools, how it works the competition to enter into the last block. So when they have to understand it and to be challenged by their own shareholders, it becomes a nightmare. So we try to educate them, but at the end, it's mostly in the hands of each company's CFO to take the decision. But as they don't have the education to understand, and the learning curve, it's quite hard, even with a simple protocol like Aave or Bundle or Morpho. So after, when you talk about investment in some tokens, that it's only for hedge funds. So they will only delegate, they will just delegate a mandate to hedge funds, but they will never do themselves the strategy. So to manage. Sorry.
Can I jump in real quick? Something that's very close to my heart. We were talking about risk and opportunity. This is the 2026 opportunities investments. To me, that's can also be outside of the space, right? Can I just quickly spend 30 seconds giving some stats? Last year in 2024, ex-China, the total solar capacity in the world was 290 some gigawatts. This year, China is on track to build 200, almost 300 gigawatt in solar capacity in 1 year. That's the total amount that every other country in the world had. This is the biggest macro story that no one are talking about. The capacity to have energy into your grid is the biggest opportunity, in my opinion, we have in the next couple of years. Why? In this space, we're talking about something that's infinite scalable. It's software. In the AI space, we're talking about something that's infinite scalable. What really hinges on these two things is compute, GPUs, and then energy. The GPUs, they need energy to function, and AI needs GPUs to function as well. But no one are talking about this big, massive solar capacity that China is building. And I bet you that all of these guys that are talking about uranium as well, they're talking about nuclear power. We just have to remember that even these small nuclear reactors that are coming out, they will take years before they're commissioned. And building a solar park with a battery is cheaper. So this is the biggest trend, in my opinion, is we gotta watch these dynamics and the demand for AI. The demand for AI is closely linked to blockchain in the future. Why? AI agents, if we're going into an agentic future, we need some controls underneath. And what better technology than blockchain to do settlement or to keep track of all these agents working together? So the next big wave for blockchain might be AI agents. So if that's true, then we have to watch for the total demand of AI. And the total demand of AI is crazy. So where are the investment opportunities? It's within the rails of this demand. And the demand scarce or the supply scarcity right now is not in software. It's in the physical world. So for the first time in probably 15, 20 years, we can find scarce things in the physical world that are really investment opportunities that can provide you 5, 10x. And that was not the case 10 years ago, because then it was all software. So that's, to me, the biggest opportunity is the scarce world that we're already living in, because AI will solve the software component. It's infinitely scalable. And yes, there'll be massive winners within blockchain and AI, but within the physical, tangible world, we have to remember that's scarce. And to me, that's where some of the biggest opportunities for the next 5 years lies.
That's a very interesting take, and I think it kind of sums up we're out of time, but generally speaking, I think...
May I add just one thing? Because is the thing, I could say many things, but actually the thing that I want to do with your question about risk is that the main risk is not to have exposure in your portfolio to this type of trends, mega trends and assets. And probably it's not that common to quote Mr. Buffett in these events, but Warren Buffett always says that errors of omission are the more painful ones. And I think not to have a little bit of Bitcoin, a little bit of what Adrian said in your portfolio is a big risk.
So I would sum it up with like, eventually it's all about balancing and diversity and also looking up to alternative markets and not only following the main road, but also look for other paths in order to get that balance that we're looking for. Thank you very much, everyone. Thank you for tuning in.
Thank you very much.